Well, friend, good morning. Jagender Rana here. So, the topic of the day is merger and acquisition insurance. Merger and acquisition insurance. The merger and acquisition insurance, also known as transactional risk insurance, provides a suite of protections aimed at mitigating risk and facilitating the successful closure of mergers and acquisitions. This insurance is designed to address the common concerns for both buyers and sellers, such as the potential impact of contractual indemnities, tax liabilities, especially for DTA risk, title dispute, or ongoing litigations on the transactions. So the recent introduction of the umbrella policy has brought in unique solutions to cover the tax liability of the past exits can be clubbed with multiple exits with regard to the DTA exposure. Now, merger and acquisition insurance has gained significant popularity worldwide, particularly in Western countries due to its comprehensive coverage model that safeguards buyers and sellers from financial losses resulting from misrepresentations or inaccuracies. This insurance allows buyers to strengthen their bids and sellers to minimize indemnity obligations, enabling both parties to close deals more efficiently, with close to 800 deals, which total to around $36 billion. It is high time that Indian companies get rightly aware of merger and acquisition insurance and its benefits. The merger and acquisition insurance market in India is currently valued at 146 billion US dollar and is experiencing a steady growth rate with a CAGR of 10 to 12%. So this type of insurance assists companies in covering losses from breaches of warranties related to corporate mergers and acquisitions and DTA tax indemnity claims. When properly structured, merger and acquisition insurance facilitates the information gathering process and clarifies the target company's status by mandating disclosures of key characteristics and issues. So, failure to disclose against warranties can lead to significant compensation claims, allowing the purchaser to recover the diminished value of the acquired company. Amid significant global economic challenges such as high interest rates, macroeconomic uncertainty, regulatory scrutiny, and geopolitical risks, India's merger and acquisition insurance landscape is expected to remain resilient over next 2-3 years. But despite a soft global merger and acquisition insurance market, Indian companies will be impacted by a robust domestic economy and are likely to view merger and acquisition insurance as a vital strategy for expansion, supply chain integration, and strengthening market positions. So, this will make it all the more important for companies to insure their transactions through merger and acquisition insurance. So, the Indian M&A insurance market is evolving and expanding in line with the growth of merger and acquisition deals as more deal makers turn to transactional risk insurance to facilitate transactions. So international private equity firms and other foreign investors are increasingly seeking robust insurance for their ventures into India's emerging market, making the use of merger and acquisition insurance for more commonplace. Higher interest rates, the prospects of political change can lead to the valuation gap between seller and buyer, which will take time to coverage. So, merger and acquisition insurance will act as a catalyst in order to bridge that valuation gap. Initially considered too expensive and inflexible, merger and acquisition insurance has evolved to adopt a more solution driven approach. So, brokers and underwriters have enlisted merger and acquisition specialists, including financial advisors and commercial lawyers, to make product and policy negotiations more adaptable to deal requirements and timelines. So, while underwriting was once predominantly tied to the UK and US markets, merger and acquisition insurance is now seeing significant global expansion, particularly in Asia, Africa, and the Middle East. So, the recent traction in Indian market towards the introduction of buy-side policies has provided greater certainty for buyers, contributing to the increased utilization of merger and acquisition insurance. So, this insurance segment is significantly expected to grow in India, will provide increased financial protection to the companies during their large-scale transactions. It is important for companies now to be aware of the significance of merger and acquisition insurance and take this coverage to secure their long-term PE deals. So, despite a decline in outbound merger and acquisition activities to $570.3 million in the first quarter of 2024, Indian corporates are poised to pursue international deals amidst global inflationary pressures. So, the value of merger and acquisition deals surged by 60% to $19.6 billion in quarter 1 2024, highlighting robust domestic deal making capabilities despite some moderation in private equity transactions. So, India is an under-penetrated market and there is a huge potential for merger and acquisition insurance in the country. There is still work to be done, but the message is being heard, and the onus is on the broking community to continue to communicate the value of merger and acquisition insurance to clients. So, the earlier merger and acquisition stakeholders engaged with us in the same way as is now commonplace in US and European deals. The more we can do to protect and expedite their transactions. The financial services sector, contributing significantly to India's economy at 10.6%, saw notable merger and acquisition activity with transactions like the merger of IDFC First and IDFC Bank, reflecting ongoing consolidation and regulatory dynamics shaping the country. So, innovative insurance products are reshaping India's insurance landscape with merger and acquisition insurance evolving to support cross-sector merger and acquisition trends. The market has seen increased participation from insurers and managing general agents, intensifying competition and driving down insurance rates from previously higher levels to between 1% and 2.5% depending on the transaction type. India's economic trajectory towards becoming the world's third largest economy by 2027, buoyed by investor-friendly reforms, robust domestic savings, and heightened foreign investments. So, the outlook for 2024 remains optimistic, driven by structural reforms, favorable valuations in private equity, advancements in AI sector consolidation, and a robust adoption of environmental, social, and governance strategies. Key sectors like healthcare, renewable energy, infrastructure, manufacturing, and financial services are witnessing heightened merger and acquisition activities. Merger and acquisition insurance has emerged as a critical risk management tool for both domestic and international firms. With the growing awareness of its benefits, increased competition in the merger and acquisition insurance market is expected to lead to lower rates and broader coverage options over the next year. So, looking ahead, India, India's evolving insurance market and dynamic merger and acquisition landscape are set to continue. Attractive attention and investments supported by comprehensive insurance solutions and strategic merger and acquisition initiatives across key sectors. So, this merger and acquisition will continue to be a part and parcel of the insurance sector, which is a highly capital intensive sector and can accommodate new entrants. So, merger and acquisition will continue to be a part and parcel. So, the past developments, parts and parcel of the insurance sector, which is a highly capital intensive sector and can accommodate new entrants with a specialized skill set having long term vision. So, the past development in the sector and recent decisions of the Mumbai National Company Law Tribunal allying merger of Exide Life Insurance with HDFC Life is an indication that entities without requisite expertise may quit the sector. In order to equip itself with the complexities of the merger and acquisitions, the Insurance Regulatory and Development Authority of India has started looking for consultants who can undertake valuations of state-owned and private sector insurers and train its officials about valuation methodology and processes. So, market players and analysts are of the view that the sector has significant potential for development and there will be new entrants in the insurance industry and also merger and acquisitions deals. So, the sector, like others, has witnessed some merger and acquisitions in the past and will continue to witness them, and newer opportunities will emerge in the future. Players with sound underwriting practices, strong financials, and right management practices will continue to grow in the long term. So, India's insurance landscape is vast and there is immense scope and enough volume for players to coexist. Given the scope for growth in the sector, both large and niche players can continue to operate in the market. Currently, there are 24 life insurance companies and 34 non-life or general insurance firms, including specialized players like Agricultural Insurance Company of India and ECGC Limited. There have been consolidation in the insurance space in the recent past. Bharti AXA General Insurance Company merger with ICICI Lombard General Insurance was completed in September 2021, and HDFC Ergo acquired Apollo Munich Health Insurance Company in 2020. In 2016, HDFC Ergo General Insurance acquired a 49% stake from L&T and L&T General Insurance. So, given the advantage from economies of scale, in all probability the top 10 players in the life and general insurance will command 90% or more of the profit pool. So, experts are of the opinion that the main requirement in both life and general insurance is to bring in more capital and invest the capital into developing the business. So, merger and acquisitions, while useful in building scale, does not successfully or does not necessarily bring more capital to the business. So, the opportunity for many more insurers to enter as opposed to a consolidation that is implied in merger and acquisitions is there. Economies of scales are important, but that can also be achieved by business growth rather than just merger and acquisition. There will be new entrants and there will be merger and acquisitions. It's a natural process. Insurance companies are also collaborating with insurtechs to provide innovation solutions and deliver a unified experience throughout the customer journey from distribution, service to claims. So, insurance sector is highly capital intensive and there is going to be continued investment activity in the insurance sector, especially with respect to insurtech companies led by private equity funds. In the recent past, several promoters of insurers have completely or partially exited their insurance ventures to focus on their core business, including the recent exit of Exide Life Insurance promoters from its insurance business and the subsequent merger of Exide Life with HDFC Life Insurance, which recently received approval from the NCLT. So, the insurance penetration in India increased from 3.76% in 2019-20 to 4.20% in 2021, registering a growth of 11.70%. So last year the government brought an amendment in the Insurance Act to allow increasing foreign holdings to 74% some 2-3 years back. So besides, Parliament passed the General Insurance Business Nationalization Amendment Bill 2021, allowing the central government to para-stake to less than 51% of the equity capital in a specified insurer, paving the way for privatization. So India is likely to become the sixth largest insurance market in the world in the next 10 years. It is supported by regulatory push and rapid economic expansions. The merger and acquisition insurance, also known as the representations and warranties insurance (RWI), is a type of insurance that facilitates smoother merger and acquisitions by protecting the buyer against financial losses resulting from breaches of representations and warranties made by the seller. So in the insurance in which the number of deals dropped by nearly 30% over the first 3 quarters in 2023, private equity firms and large asset management continued to invest in assets in North America to the tune of $7 billion. Deal activity dropped for property and casualty insurers too, with 30% of the segment's 2023 deals classified as minority deals versus 50% in 2020, and in brokerage, which represents more than 70% of industry deal volume, activity slowed by 12% in the first 3 quarters of 2023 compared with the same period in 2023. So, companies that traditionally built their competitive advantage around underwriting risk and operations excellence increasingly are moving to extend their offerings. So the time is there in India to increase the M&A insurance, and this will automatically increase because M&A deals will take place in future also. And this is having the very bright future that merger and acquisitions will continue to be a part and parcel of the insurance sector, which is a highly capital intensive sector and can accommodate new entrants. Thank you very much.